We still like credit, corporate credit in particular. We think that businesses have figured out how to readjust their P&Ls for lower volume, and we like high yield debt right now. Other than that, no, we like most corporate credit. Real estate, I said, if you wanted to include real estate as credit markets, we're not crazy about real estate.
Do you anticipate a further tightening of spreads in high yield, because they tightened dramatically, then they backed off a little bit, and it seems that there's a difference of opinion as whether they're going to continue backing off or whether tighten back to the lows that we saw just a few months ago?
We think spreads will come in. There's obviously they've gone out some because I think people are more concerned about the economy today than they were even 6 months ago. But I think the amount of money still in the corporate credit markets is massive. There's tons of money trying to be put to work, and we think that'll bring spreads in. Large states like Illinois and California are very risky and don't appear to be worth the return they're getting. There are many other states which have good corporate or good credit, and they're fine.
You were selling muni debt selectively back in March.
Yes.
What are you doing now?
We're continuing to sell down. Our view is, if you don't like the income statement, you don't like the balance sheet, you're not sure about management, you don't like the governance, why would you invest in those places? And so we've been getting smaller in those places where we're concerned about those four items.
How big is municipal exposure as a percentage of your total portfolio now relative to where it was, say, at the end of last year?
It's down from 23 billion to about 20, and it's still heading south.
And how far down do you envision taking it?
Not sure yet. There are certain types of bonds that we don't like, appropriation bonds, some hospital bonds. Mostly general obligation bonds will stay, so it'll still be in the double-digit billions, but it won't be as high as it is now.
How long do you think it takes before we see a genuine default-like event in the municipal market?
Well, you'll see small defaults. I don't know if it'll be a major borrower. I think our concern is not necessarily that we won't get our money back eventually, because the way the bankruptcy laws work, you generally get your money back. But in the meantime, the value of those securities will go down as people readjust risk. So we're more worried about the market value than ultimate not getting our money back.
How great is the risk of a double-dip recession right now?
I don't think we have a risk of a double dip, but I think we're in for a long road. I think out from here. I think it's almost like all of our past due bills came due at once. They all came in the mailbox the same day, whether it's bad education, spending too much money, not good enough infrastructure. And so I think it's going to take us a while to work out of that.
Is there one single threat to the economy that you're more concerned about than any other?
I think that there are a number of things we're not anticipating. So you could have major catastrophes, you could have problems with weather that relates to agriculture output. And so I think there are, what tends, if you look back over history, we tend to know what's in front of us, and then it's something we're not thinking about that catches us.
How big of a concern should the federal deficit be for anyone looking at the economy right now?
I think I would broaden it, Eric, to say not just the federal deficit. I think the government borrowing is way out of control. And so that's state, local, and the federal deficit. I think the federal government obviously has more wherewithal to pay back, but we need to get our house in order. I think you can always have a government spend more money than it takes in, but not at the rate we're doing it. So it needs to come down.
If that's the case, just how long can this Treasury rally last?
Well, the Treasury rally will last until we start restricting the money supply. So right now, the doors are open. There's plenty of liquidity. There's plenty of cash in the market. And when that starts to restrict, then I think then you'll see the wheat be separated from the chaff, and the bad credits will be really bad credits. We're short in duration, so we don't like to go long. We think there's a greater chance that interest rates will go up, and we're spending hundreds of millions of dollars hedging off our portfolio for a large spike in interest rates. We think eventually rates are going to come up. Don't think it'll be next week, probably won't even be this year, but you'll never be able to guess exactly when it happens. So we're looking out over the next 2 and 3 years hedging off interest rate increases.
When did you begin to do that? How long a process has that been?
We started doing it last year, and so that's been insurance we bought, which we've not had a claim on if you go to my world, and it's been expensive. But it's still reduced our risk, so we're comfortable with it.
What do you think it's going to mean to investors, to the economy, when that big sell-off in the Treasury market finally happens?
Well, I think it'll put further pressure on the availability of credit, which is, of course, what we need to get going to get the economy. So I think we're going to be stuck in this sort of high unemployment, low growth mode for a while.
Is the president, though, in that context, right to put growth before fiscal responsibility right now?
I think from a federal government standpoint, we do need to do something in terms of driving growth. I don't know that it means spending more money, though. I would say you could reallocate money. So we spend $700 billion a year on defense. We spend 40% of the world's amount of money on defense, and we have 4% of the population. I think you could reallocate some of that money to growth, and that I would rather see us do that than go farther in debt.
Is that uncertainty over government policy affecting your ability to make business decisions right now?
I think it's impacting everybody's ability. Oh, I don't think it impacts your ability to make a decision. I think you make a different decision because of the uncertainty. And so I heard last night 80 to 100 companies of the Fortune 500 have over $5 billion in cash in their balance sheet. All that money could be reinvested in America or in growing our businesses, and it's not, I believe, because people are concerned about what the future is. Some of that is because of what the government will do. Some of it's just the economic uncertainty we're just talking about.
Do you feel similarly inclined to keep more cash on the balance sheet than you might otherwise put there because you're not really sure how to spend it right now?
Absolutely. Our risk profile, we have a $100 billion portfolio, Eric, and our risk profile of that is much lower now than it was 4 or 5 years ago because we're uncertain.
Well, America wants companies like Allstate to take risk. What is it going to take for you guys to grow comfortable taking the kind of risks you once did?
Well, I think we have to see some stability in the worldwide economy, not all of which is controlled by our government or our businesses. So we need to see some growth. You're starting to see some emerging markets continue to grow. People are a little worried about China, but I think some worldwide growth. I think, and then clarity on what the rules of the game are in the United States in terms of regulatory infrastructure, what the rules are, what tax policy will be.
A lot of your shareholders want to know when they're going to see a 41-cent dividend again. What kind of hope can you offer them?
We look at dividends. Of course, it used to be that high. Now it's half that level. And we adjust it based on earnings. So I view, if you look at our payout ratios now, they're about where they've been historically. So as earnings go up, we'll increase our dividend. The big challenge for us to raise earnings right now is to have our homeowners business make more money, and so that's what we're focused on.
If we do in fact have, call it a benign storm season, might that be a catalyst for a dividend hike come 2011?
If we continue to build capital, we have excess capital today. If we continue to build capital and we like where earnings are, yeah, sure, we'll increase dividend. The middle class is under siege. I think it's a huge problem. I think they're going to bear the brunt of the impact from all the things we haven't fixed in the past, whether that's borrowing too much money at the state of Illinois or a bad education system. And so we have to sort of reboot the whole system to get them back to where they need to be.
The president was elected on a pledge not to raise taxes for the middle class. Do you think he's going to end up in that position anyway?
Well, of course, it all depends how you define the middle class. And more people define themselves in the middle class than there are probably in the middle class. But if you look at people who make between, say, $40,000 and $90,000, which is what Pew would say, it seems hard to believe that you could actually generate enough cash to pay off some of the government's debt without taxing them more.